Alright everyone, welcome to a new video. We're going to get straight into the topic. No one does intros on YouTube anymore, and I understand it. So today we're going to talk about exiting early, and this is trading related. So you are in a trade, how do you know when you should exit the trade early? This is our topic today. This video is not necessarily for beginners, but if you're a beginner, make sure to watch this still. And also make sure to watch the full video, because in the end I'm going to announce a free Discord channel which you can join. So that's going to be in the end of the video. Now I have a couple of things I want to talk about in this presentation, and then we're actually going to look at the charts. So for this video I have decided to define what I mean by exiting early. With this. So the topic of this video is that price hasn't gotten to either the targets or the stop loss, and that is what we're talking about now when I mean exiting early. Okay, so you are in a trade, you've bought the market, you haven't hit your targets, but you also haven't hit the stop loss, so you are kind of in between. Okay, also works on the sell side as well. So that's what we mean by exiting early. Now it's very important to distinguish between winning and losing trades, because these are two different things. If you are in a winning trade, reasons to exit early are completely different than they are if you are in a losing trade. So in a winning trade, typically you exit the same way you enter, so you trail out. Okay, and a losing trade is cut short. Okay, so this is the difference between winning and losing trades. In a winning trade, you trail out the stop loss. Okay, so you end up taking profits, and a losing trade should be cut early. Okay, and also the trades that aren't really going anywhere, so you're not necessarily losing or winning, but they are going sideways, I'm also going to include into this video. So I think it's very clear to distinguish between these three. So winning trades are that price is clearly going into your direction, but you just haven't hit the target yet. And a losing trade is when price is clearly going against you, but you haven't quite reached the stop loss yet. And then the sideways trades, which are also included, are that price is kind of moving in between your target and your stop loss, but it's not necessarily pushing hard either way. So those are the three situations or examples which we're going to talk about in this video. Okay, so we have the charts now open, and I actually made this chart in a cumulative delta guide. So if you're interested in that, I would recommend that you go watch that. And also, if you want the best kind of in-depth guide on the cumulative delta, which is down here, I recommend that you go watch that. And also I'm going to use the cumulative delta in this video, so if you don't quite understand what I'm talking about, you kind of have to go and watch that video, because obviously I'm not going to explain the same things in every video. So let's talk about the winning example first. So we are in a winning trade. What do we mean by exiting early when we are in a winning trade? And there's a very important concept that you have to understand when it comes to winning trades and trading in general. Typically, what you see with professional traders is that they scale in and out of positions. And basically this is done in a way where once your own confirmation in a trade increases, you also increase your risk. Okay, so you increase the size of your trade gradually. You don't jump in the trade with your full size immediately, but once price starts to do things you want it to do, then you increase the size more, because now your own confirmation with that trade working out has also increased. So I actually found a perfect example. This is yesterday. You can actually see here that this says 23rd. So we're going to talk about this region here, and I think this is the perfect place to establish what do I mean by scaling in. And that is a very big topic which I'm not going to really get into too much today, but I have to talk about it a little bit for you to understand what do I mean by scaling out. So you can see here that we had a very good entry here for a buy, and the price didn't really go anywhere. It kind of stopped out. It kind of hit a wall here and came right back down to the same level. And honestly, if I'd had to guess, I think there's some kind of a VWAP going on here, which the price bounced from twice. So when we talk about scaling in, let's say you bought the market right here. And again, I'm very sure that this is some very important level. Once you get the confirmation that price wants to go up, but it comes back down to the same level, and then we have what we could call the double delta reset. Again, if you didn't watch my cumulative delta video, I recommend that you watch that one. We can very easily here say that this second spot here, so number one, if you didn't get into the market here, this is your second chance. But two, if you did get into the markets here, this is your place to add to the trade. This is where you scale in, because prices come down to the same level. It hasn't gone negative cumulative delta, so it didn't push through, and also it didn't drop on the chart. Okay, it stopped, hit like a wall, okay, bouncing up. So that's where you add to your position, and this is where you scale in. Why am I talking about scaling in? Well, when you scale in, that tends to mean that you have multiple targets, okay? You don't set all your targets to the same place. So this would probably mean that you have some targets maybe here, maybe some targets are here, and some are all the way up here. And this is now going to be very relevant when we talk about scaling out and exiting early in a winning trade. So this is scaling out, okay? So you have multiple targets for your positions. That way you can exit the market gradually, taking some of the profits home. And that way, if the markets do go against you, you don't lose everything or all the profits you've made thus far. So just to establish the point really well, this is now another day. This is the 22nd, okay? And I saw that there was a very good example here on the same point again. So we have some level here going on, and if you missed the opening here, you know, the opening short, you had two more chances to sell the market or to add to your position. So with that now being very well established, let's talk about trailing your stop loss, okay? Trailing the stop loss is the way we exit early when we are in a winning trade. So I'm actually going to draw now so you really get the point well. So we have bought the market, and trailing the stop loss means that price is going your way and you have already hit a target, okay? You never want to trail a stop loss unless you have hit some targets, okay? You have taken profits home. That's the only reason you should trail a stop loss. You should always try to let your winners run to a target before you close the trade. Now, obviously, if market reverses, then you have to exit no matter what. But this concept of trailing the stop loss only really applies once you have taken some profits home. Then we are talking about exiting early. Again, if it hasn't hit your target yet, then you are kind of in this in-between zone yet. So this doesn't really apply. So we have bought the market and price is going up. Okay, so we're in a winning trade. We have taken some profits off and market comes down a bit and it goes back up. Now, trailing the stop loss means that you put the stop loss, in this case, just below the previous low. Okay, so just below where the new up move started. okay? And once this happens again, right, you move the stop loss again, okay? Third time, you do it again. This is what trailing the stop loss is, and this is a very important thing to do. And sometimes what tends to happen is that price comes down and it hits your stop loss and maybe goes a little bit below, and then it, you know, goes really way up, right? But you know, these things happen. We can never have perfect kind of knowledge where markets are going to go, but the point of trailing the stop loss is that you maximize the profits with minimal effort. Okay, it's very easy to do this, and this actually allows you to step off the screen, so you don't have to stare at your trades constantly. Once you have taken some profits off, you can wait for price to go to your direction a bit more, and then when it makes that initial drop and it goes up from that, then you put your stop loss right there, and you know, you just repeat that motion. And typically what happens, and this is what happens most often in my experience, is that price, you know, it always makes a new peak, right? So this is now the new peak here. But what most often happens is that price tends to come down, you know, and then it does something like this. So this way you really easily get to maximize your profits. And I'm just going to try to find a very clear example on the charts about this. Okay, I think this is a pretty good example here. So here we have the 17th right here, and we can see that price is going down. So we have sold the market, right? And price is going down. And this is actually a very kind of clear example where we would maximize the profits indeed. So we have, you know, targets all over the place, right? But we have some ultimate target way down which we want to hit, or which we're hoping to hit. We've taken profits off, and price makes the first kind of push upwards to test if a reversal is possible. It continues downwards. You know, we put our stop loss right there, or even closer. Sometimes I put it very close. Sometimes I'll actually put it like in between or in the middle of that. But as a kind of clear rule, I would say that just put it just slightly above, right? So in this case, what ended up happening is that we had a reversal, and this way we were able to actually maximize the profits. Now, hindsight, obviously you would have wanted to exit here, okay? But again, we are not robots, and this is a significant period of time. No one's going to watch the charts for hours and hours and hours. We need a simple system where we can maximize the profits to the best of our ability with, you know, human effort, okay? We're not robots, so we can't trade like robots. But this is a very clear example where I think trailing out the stop loss after hitting some targets would have been very beneficial. So that is the first example on when you should exit the markets early. Now let's talk about losing trades, or cutting the losers short. Very, very important. I would say that this is even more important than letting the winners run. Cutting the losers short, in my opinion, is more important than actually maximizing the profits, because big losers are very demoralizing, okay? Everyone knows that once you have a really bad day in the markets, like you lose a lot of money, that really gets to you. It really gets to your head. And it's very hard to get back to that winning mindset after you lose so much. So I actually think it's more important to focus on not losing than winning as much as possible. Okay, so let's talk about cutting the losses short. So obviously we understand what this means. I'm just going to draw on the white thing here again. So let's say we've bought the market again, okay? We bought the market, price did go up, that's why we bought the market, but now it's coming down. It's coming down. Our stop loss is right here. It's about to hit. How do we know that price won't just bounce up from here, right? Well, we don't know, right? So we kind of have to guess. Well, not really guess. So we have to look at all the relevant data to determine whether we should stay in the trade or get out early, okay? And we know that once we are in a losing trade, there's kind of a pressure to defend your position. This can give us a false sense of security because ultimately we don't have enough capital to actually defend our positions. We can't reverse price. So if price is coming against us, we are just an insect to be stepped on, okay? So there's no point really trying to defend your positions. If you think the price will hit your stop loss, you should exit early, almost always. Now, sometimes what tends to happen is that you cut the trade short and then it goes like 1 to 2 ticks below and then it goes up. And in those cases, you have to be willing to re-enter the market, because that obviously means that your initial thought or your read of the market was completely correct. You were correct, but your timing was slightly off. And in that case, you should be confident in re-entering the trade because that means that your initial ideas and thoughts were correct. And also learning to time your trades better gives you much more kind of leeway when it comes to price going against you, because if you get a better price, then you can put your stop loss further away. So getting a better entry timing wise means that you'll also have a better stop loss. So you have a slightly lower risk of hitting that stop loss once price is going against you, even if it's just a kind of short-term move. Okay, so I think I've found a pretty good example here on cutting the loser short. Now, it's quite hard to actually kind of imagine that I'm in a losing trade. So this will be more kind of easier to interpret once you are in your own trade and you are losing money. But we're going to look at this now. So let's talk about what happened in this day. We had, so this is market open here, okay? And price went up to some level and basically dropped from there. But if we look at the cumulative delta here, we can actually see here that it came to just about 0, right? And it bounced up from there. So it's very easy to see, based on the cumulative delta here, that this could be a delta reset, okay? Once the cumulative delta goes above, so in this area here, right? And this could be a reason to buy the market. If you bought the market here, based on what the cumulative delta was telling you, you weren't necessarily wrong, even though the trade did go against you ultimately, but you would still be you would still have some base for your trade. Again, this is not a perfect example, but obviously based on this, you would want to probably put your stop loss somewhere around here. So in this instance, cutting the loser short would mean that you would exit before price hits your stop loss. So, you know, in this region here, right? And this is a very important concept to fully understand. And this short video isn't going to do justice for this. Again, in my free Discord, I might talk about these topics more. And obviously in the future, there will be more content relating to this. So if you don't understand this fully now, it's fine. We'll talk about it in the future as well. Let's really analyze what's happening here. I know this is kind of going on and on and on, but I really want to make this quite clear. So we have our stop loss here, and obviously we have our target somewhere over there and probably right here. And what we are looking at once we have entered our trade here, is that price is refusing to go upwards, okay? And cumulative delta is refusing to go upwards. And this is a huge red flag. This should immediately alarm you, okay? If you have entered the market and price doesn't go your way, you should be alarmed immediately. Now, sometimes it just goes sideways for a while and then it goes up. Sometimes it just about hits your stop loss and then it goes up, but you should still be quite alarmed. So right here, you can actually see that in this instance here, the cumulative delta comes back to 0. And honestly, this is probably where I would want to exit early. So somewhere over here, I think, where I would be thinking that, okay, price obviously doesn't want to go up. We can see it in the cumulative delta. It's not going anywhere, right? There's no aggression. If price really wants to go to your direction, you can see it in the cumulative delta quite clearly. It does something like this. It just bounces, but obviously you can't see that here. So this is a very clear example on where I would exit early. Once the cumulative delta hits 0, and you can see price start to go down, go down, go down, go down, just cut it. Cut the trade. You're losing money. Price isn't going your direction. Now, what could happen is that it goes to your stop loss and then it bounces from there. But are you willing to risk that? So sometimes the worst thing happens is that you cut the trade short and then you have to re-enter and you've already taken a loss and now you have to ride it even longer. But this is part of the game. I would rather cut the trade short and re-enter than not cut the trade short and hit the stop loss and continue going to the same direction. So that is the second concept of when you should exit early. Now let's look at the last one. So the last one is probably the easiest to explain, and we have our target here, our stop loss here, and price is basically just doing this, right? It's not going anywhere, and this happens sometimes. It doesn't happen that often, but we all know when we are in a trade like this, we always kind of wait for price to push up and to hit our targets, but it never happens. We've been waiting for 30 minutes. It's time to cut the trade. Okay, price isn't going anywhere. And do you want to sit and look at your screen and get frustrated? I don't want to do that. That leads to emotions. Emotions leads to losing. And listen, there's always going to be another day to trade. This day just wasn't it. Sometimes the timing is wrong. Price just wants to hang around a bit more before it can move. That happens. So what do I mean by this is that when you are looking at the markets, price is doing this, right? Then when you close the markets because you got frustrated, price goes up, right? And you had bought the market, right? But you can't really, in my opinion, I wouldn't want to risk that, okay? So this would mean that we would have to let our stop loss just sit there without us actually being in the markets, because we're not going to be able to stare at the screen the whole day unless we work at a bank. But it's very important to understand that when this sideways action happens and you decide to exit the markets, there's always going to be another day, okay? Even if you exited, let's say we entered right at the middle here and we exit right at the end here. Yes, it's a loss. Ultimately, I would say that every trade that isn't a win is by default a loss, right? Because you traded and you didn't win. So for me, that's a loss. But this really isn't kind of a, it's not a losing loss. It's more of a just price doesn't just want to move kind of loss. So this isn't this is not going to have any psychological effect if you just take a small loss because price wasn't agreeing with you. So this will also be a part of minimizing the losses when you recognize that your timing is wrong and you just want to get out because you have no reasons to be in the market anymore. Just get out. And let's try to find a very clear example for this, and then I think the video will be over. Okay, so I think this is a perfect example. This is the 21st now, and we can see here, this might actually be a bank holiday, I'm not quite sure, but we can see that price didn't really go anywhere. And this is exactly when, if you had bought the market and, you know, price is just basically just going sideways. Let's actually look how many points that is. So 59 and 88. It's good movement still. But let's say you got a kind of a bad entry, okay? So you entered here, right? Your stop loss is, I don't know, either one of these. Even when price is coming down here, it's not hitting your stop loss. It's just, right, sideways. It's not hitting your targets. It's not hitting your stop loss. What do? Just get the hell out. Get out. It's not going up. It's not going down. Price just wants to go sideways, right? And we have to accept that. I think the key thing is that we have to accept what price is doing, okay? If it's going your way or the opposite way or sideways, you have to accept price is doing exactly what it wants to do. I think that's a very important lesson for everyone to understand. And that's been it for this video. Now let me introduce you to my new Discord. Alright, so now that the video is pretty much over, I want to introduce you to my new Discord server. It is called the Free Trading Floor, and the link to this will be the top comment, as well as my Instagram link will be there. So come join my server and also follow me on Instagram. If you have some questions you want to ask me, it is more likely that I will answer to you in Discord or in Instagram than YouTube comments. So with that being said, come join my Discord, follow me on Instagram, and I hope you enjoyed this video. See you in the next one.